Hi, I'm Ken Riggs with Real Estate Research, and it's great that you're joining us today. We are going to cover our third quarter real estate report. That is in process. We've completed the research and it'll be released in the next couple weeks. And joining me today is Dane Anderson, who is a valuation director with Real Estate Research Corporation and also the Midwest practice leader. Thank you, Dane, for being part of the program today, and I look forward to our discussion.
Thanks, Ken. I'm excited to be a part of this presentation and little highlight of our report. Do you want to jump right into where investors are placing capital?
Yes, it's a good place to start, and as indicated by the slide, what this rates on a scale of 1 to 10 is what's the relative attractiveness of commercial real estate relative to stocks, bonds, and cash. And what we look at very closely is the trend line, and if you go back to second quarter 2012, the rating on that scale is 6.8, and you can see that for the following quarters, it stayed about the same and peaked the beginning of this year at 7.1. What I point out to the listener is that it now has dropped to 6.3. And it doesn't go into a reversal mode, but it clearly shows that there's a risk-off type of attitude. That commercial real estate, and also the same for the stock market, for the third quarter 2013, from a risk perspective, the respondents are indicating that it is a riskier environment.
All right, Ken. So this is a bit getting into the next slide, but do we see anything that's really causing this? Is it the uncertainty with the Fed or the interest rate environment? I guess we should just jump to the next slide.
Yeah, I think it's a perfect transition, Dane, that there has been a shift from, this, I think, risk off. The terminology today is risk on, risk off. And there is this, I think, greater level of uncertainty, slower economic growth, and many of our survey respondents point to the fact that it's fiscal issues, not monetary issues. It is politics over people, that Washington, D.C. doesn't get the impact of these budget impasses, the debt ceiling, that our survey respondents are saying there's much more corrosive damage and also collateral impacts to what Washington, D.C. Is doing today. And also, the Fed, with their potential tapering coming at some point, maybe sooner than later. I think it'll be later. So interest rates are viewed as a risk. It's interesting to see on the interest rate front that many respondents view there is enough of a cushion, so to speak, with risk-adjusted returns to absorb interest rate increases.
That kind of leads into our next slide here, the availability and discipline of capital. Are we seeing any real change this quarter?
The general comment, Dane, would be that there's too much capital, there's not enough product, and that commercial real estate investors are moving out on the risk spectrum. And even though it'd be counterintuitive, that really segues or connects to the comment about the attractiveness of real estate falling a little bit, because there is this more chasing of investment. And what I quickly point out is that the strong blue line indicates the availability, and there's been a slight dip, but it is above the discipline, and the gap is relatively narrow, and that's what we're watching, that gap between availability and discipline. So next quarter, I will be curious to see if that gap narrows or widens, because if you look at pre-credit crisis, right around third quarter 06, the gap was large. The spread was probably 3 points plus. So that's what we're watching, that relative spread. And that spread was very predictive of what happened during the credit crisis on availability and discipline of capital. But right now, robust capital, discipline staying steady, but there is a gap.
As we move to the next slide, it summarizes what our respondents are currently indicating for internal rate of returns and going in cap rates. Can we correlate this back to the discipline and availability of capital?
I think it's a good way to look at it, Dane, because if you first look at IRRs, which is a discount rate in the valuation community, you can see the column labeled BPS change, which is basis points change from the prior quarter. You can see that all of them have gone up, meaning my expected total return or discount rate is higher than it was last quarter, and that range goes, I would call it a median range of around 25 basis points up to 70 basis points for hotel. So the message from a discount rate perspective is I need a higher return given greater uncertainty. Plus, I'm reaching out to, and the comment is I'm reaching out to products, investments. Let's get investment opportunities into more secondary markets, riskier profile properties. So I want a higher return, because I would state that this is not the case for the very top tier properties in the top tier markets, where on our investment calls, the comment is they've not seen as much competition for these major deals since pre-credit crisis. And the prices reflect that. If you monitor any of the top prices in New York, top prices on the West Coast, San Francisco, LA, Washington, D.C., you'll see that. So I think we do need to be careful in how we paint the picture. So on the discount rate side, we do see that reflection. If we go into the going in cap rate range, I think that shows a different story, and it speaks to a different approach, because you'll see that, again, from quarter to quarter, the cap rates for industrial properties have gone down by 10 basis points. That's the same case with retail power centers, but we have had others go up. And the cap rate is not only reflecting many things, one of the most important is reflecting growth. And so I do view that it's an interesting time to be very careful to pay attention to discounted cap rates.
Hotels really sticks out. Did we have any news or anything that would have pushed up the discount rates on those so much, or is that just that move towards the less risky investments?
I would say that, Dane, it reflects kind of that shift to away that risk-off type of philosophy. So putting hotels are viewed, as a composite of, what's happening in the economy, and also they have a business element to it. In addition, there has now, because hotels have been doing so well, there is supply coming on in some of the larger markets. So there's always a combination of factors, but I think your point probably is the most salient today. And I would also state that's, to me, one of the factors that is attractive to commercial real estate and segments the different property types is how much supply is coming on. We've been very fortunate in this cycle to have very little supply come online, except for apartments. And if you look at apartments, you can see that the discount rate's gone up 30 basis points, but over the last quarter, and the cap rate has stayed unchanged. So I think there is a reflection of that, factor of, what is the risk, what is the supply-demand fundamentals outlook. That's my perspective, Dane. What do you see happening from a valuation perspective with cap rates?
Yeah, Ken, we've seen over the past several quarters general stability overall in the appraisals that we review, and also the spot transactions and comps that they include. You could say they're a bit lower than last year, but not significantly different. Multifamily appears to be leveling off, which could be expected with as much cap rate compression and new supply and everything that's been going on there. Industrial appears to be heating up with some compression since last quarter, and I think our report reflects that. And we've also noted that the cap and discount rate spread appears to be tightening a bit, especially with those high-quality industrial assets. And that would hold true for high-quality retail assets as well.
I like that perspective, Dane, because what you reminded me of is the fact that it's so hard to use our survey and, in broad brush what's happening in the marketplace. And that, our survey serves as just a benchmark, to look at what's happening, what's the relative level, compare property types. But when you drill down to specific situations, specific product types, specific markets, that's where, the judgment and kind of other aspects of what you do comes into play.
Sure, more of a tool for the appraisers and analysts and investors.
Yes.
All right, let's go on to the spread between institutional pre-tax yield rate and the 10-year treasuries. What does this really tell our readers?
We've monitored this for years, and this, as you indicated, is the spread of what is the total return on average that we're seeing from a survey participants versus a 10-year treasury. And you can see that today it's still at 600 basis points. On a relative historical level, it's still at a very positive risk-adjusted perspective. To me, the simple message is commercial real estate is still attractive, relative to what type of total returns you can get from, again, the benchmark 10-year treasury. It also tells you, are we moving into, I think, riskier territory? And if you look at pre-credit crisis, you can see 07 and before, we were between 300 to 400 basis points. So if you take the low point pre-credit crisis, the relative return for commercial real estate is still almost double what it was pre-credit crisis. And I will tell you, so what it tells me is that you can see it's coming down over the last year, down probably 100 basis points. It was 700, now it's 600 basis points. But it tells me that there still is enough cushion as long-term treasuries move up. So if the anticipation is if long-term treasuries go to, up another 100 basis points, another up 150 basis points, you still have, relative spreads for commercial real estate at 500, all else being equal. Now, that doesn't mean that the real estate return will go up. So it is something to look at and measure how attractive is commercial real estate compared to the financial markets.
All right, and that spread actually a bit segues into our next slide about rental growth, because quite a bit of that return is going to be through the growth in rents, since appreciation could be held down a bit. What are we seeing for rental growth for this quarter's survey?
As you look at the top line, which is rental growth, and I keep looking at first what's the average total, it's roughly 2.5% to 3% range, just generally for rental growth. But what's interesting, you can see that many of the respondents on rental growth for the respective property types have dialed it back. So from last quarter, it's down. Again, you can use a range of around 10 to 15 basis points from prior levels. So, if you interpret that, that means that, we probably moved closer to a 2.5% rental growth versus before a year ago, it was probably closer to 3%. I think you have to contrast that, and that's the part that you have to, start to be concerned about is on the expense growth level. Many have estimated that expenses will go up, that we're going into more of an inflationary environment. Nothing crazy, but we're probably leaning more towards the 2.5% to 3%, more towards the 3% range. And I know, and some might respond by saying, well, geez, inflation expectations by the Fed are very, very low. But we have to look at what are the inflation factors for commercial real estate, such as real estate tax is a very big component, insurance, electricity, TIs, things of that nature. So I would say the summation of this chart, Dane, is the fact that rental growth has dialed back somewhat, expense growth has dialed up somewhat, which again, you don't like to see that happen. However, you have to tie the whole picture together of what's the total returns, what's the cap rates, and things of that nature. So all in all, it is something for us to monitor in the context of what's happening in the other, other reporting sectors of commercial real estate.
Okay. And I know one of your favorite parts of doing this research is hearing from and reading the actual comments of some of the respondents. So we've summarized a couple of those comments on this next slide. Do you want to go over those briefly?
Yeah, and I would agree, Dane. We should have a podcast that just covers the comments from the survey respondents, because they take a lot of time. They're thoughtful. They are the investors that are active in the marketplace. And this reflects more of a consensus. And it's not a 100% consensus, because I tell you that I've got them spread out over my table. There's, probably 7 pages of comments from the various individuals. And I would say, as I look at them before I jump into this, is that they're probably as varied as I've ever seen, from product type, from risk profile, from, is it a good time to invest, bad time to invest, what keeps them up at night. But I would say that this is kind of more of a general theme, is now, that the market is chasing product, which doesn't surprise me that the coastal markets have been played out. As I mentioned, interest rates will rise, but they view the market can absorb this change, meaning the commercial real estate market. They have greater concern, obviously, about the bond market absorbing an interest rate hike. They have greater concern about the ability of the stock market to respond, because many believe that, what's happened in the stock market is Fed supported by all of their monetary policy, with the headwinds being fiscal policy. And at the end, I know that these are commercial real estate respondents, but I would tend to weigh in too, is that given what we know today with all the uncertainty in the economy, the global picture, the financial markets, the fiscal, meaning the government, etc., that commercial real estate today offers a very attractive investment. Most of the return for commercial real estate is in income, approximately 70 to 80%. It has also been less volatile. We've learned a lot from the lessons we were taught very severely in the 90s. So overall, it offers the best risk-adjusted opportunity with what we know today. And that doesn't mean that landscape doesn't change over the next 3 months to 12 months. And that's just the nature of investment markets.
Okay. I think that's all we have today. I think that's a nice summary for the listeners. When can our subscribers expect the third quarter report to come out?
Dane, the report will be out roughly November 10th. We close out all the survey processes towards the beginning of October, the end of the quarter, and now we're in the process, as we're doing today, collecting all the themes, the focus, and the message that we're getting from the survey respondents. And I'd like to, thank the listeners for, jumping aboard. I will tell you that we will, improve what we're delivering to you in a more timely, I think more effectively, and also just in a, I think, more thoughtful way. And so be patient with us. And I'd also like to thank Dane for